Hi, and welcome to a new episode in our Thought Leaders series on Optimum TV. I'm Stephen Adams, and I'm delighted to say that we've got Melanie Senior back with us today. As you probably know, Melanie is a journalist who writes about biopharma for the Nature portfolio and Evaluate. So hi, Melanie.
Hi, Stephen. Nice to be back.
Great. Last summer, you talked to Optimum TV about a feature-length piece you wrote for Nature Biotechnology about the state of the biotech financing environment. And things were pretty tough back then. Now you've written an update for mid-2026, which is titled Biotech's Coming of Age. And it's safe to say, isn't it, that the picture is a little bit happier than it was 12 months ago. But not everything has changed. Some things have changed, but others. So talk us through how the mood has shifted in the biotech financing environment, how things have changed and how some things have stayed the same.
I think we're still in a risky environment. There's still caution around, but on many metrics, things are a lot better. We've seen the XBI index, hovering near its all-time high. M&A is definitely back. There are some really big total deal values being predicted for 2026. But I would say, and I think I use these words in the piece, it's more of a sober mood than a jubilant one. Because there are other factors at play as well, and it's a very discerning market. So yes, back and better, but it's not party time, I'd say.
Okay, so this isn't a rerun of 2020/2021 then?
It is certainly not a rerun of 2021. That's a reasonable question to ask, given some of the numbers here. This is a much more discerning market, as far as investors are concerned, both private and public investors. I think a lot has been learnt from the exuberance of 2020-21. There is a preference still for assets over platforms, for later stage, preferably clinical stage assets. We're no longer in that era of anything cool technological platforms, this, that, and the other can go out on the market and list, etc. That's definitely not happening. We are seeing IPOs come back, but it's not everything and anything at all. And don't forget, there are still these other uncertainties, these sort of external factors swirling around, whether that's geopolitics, whether that's the economic uncertainties, associated with the war, with interest rates. And then, of course, we've got this swelling sort of technology AI sector, which does have a big pull on the markets overall and can and will and is having a knock-on effect on biotech. So those things to bear in mind.
Okay, interesting. If we think about different types of investment, and I'm thinking about sort of M&A, IPO, which you mentioned, R&D partnerships, where has there been the most positive movement over the last 12 months, and where has there been less change?
In overall numbers terms, I think it's all positive. I mean, I've doing another podcast the other day, and it was very much sort of the numbers are bigger and better and bolder everywhere. But I think you need to look behind those. So, let's take IPOs. They were slower to return, and they're only just getting back, building momentum now. I think we just last week, didn't we? We saw Parabilis Medicines go out. That's an oncology company, raised, I think, over $650 million. I think one of the largest biotech IPOs ever. And I know there are others waiting in the wings, but we're talking clinical stage IPOs. One of them earlier this year, Generate Biomedicine's got a phase 3 antibody targeting a TLSP, so a target that's very well known, where there's already an antibody for sale. So these are not hugely risky programs, but it's encouraging nevertheless. We're seeing a cardiovascular company lining up to go public, and there's even a gene therapy company out there that said it wants to go public this year. That's Aspen Neuroscience, and they have a gene therapy for Parkinson's disease. So again, it's a nuanced picture, but I'd say IPOs is the more recent recovery area. M&A has been really booming since the second half of last year. And as I said, the totals are on track to be big. We've seen a lot of, deals over $5 or $10 billion, although we haven't seen mega M&A. And then R&D partnerships. I mean, this is an interesting area because we've seen several of these multi-asset deals between, Western pharma and China, of course. So I think we're going to be talking about that today, Stephen, aren't we, China? We've seen Pfizer's multi-asset deal with Innovent the other week, involving, a dozen or so assets for, hundreds of millions of dollars up front. BMS did a similar deal with Hengrui a few weeks ago. Takeda's also partnered with Innovent. These are large deals. Some of them are repeat business. And it very much speaks to China as a dominant source of licensing deal assets, and increasingly of assets that biotech companies are being built around, and also assets that Western pharma are buying. So, for example, just to cover off M&A, your other you mentioned as well, Merck bought Terns for $6.7 billion. Their oral tyrosine kinase inhibitor was from China, from a company called Hansoh. Similar story with Rapt, which GSK bought with an allergy asset. So, yeah, very much a China theme.
Now, in terms of what companies are getting the investment, what are getting the capital, the theme of the last few years has been later stage assets, and earlier stage companies, by and large, have really struggled. Is that still the case, despite the fact that there's more money flowing around, or are things changing?
Obviously, the GLP-related assets, they're still hot. All the incretin family, we're still seeing a lot of licensing of those types of assets to try and sort of better tirzepatide and the injectables that are out there. We're seeing a lot of them coming from China, and that in turn is fueling startups that license these assets that investors are then very interested in investing in. So we saw, Alveus Therapeutics raise a huge A round in February, $200 million, I think, with a GLP asset from a Chinese company, purporting to provide higher quality weight loss. That's the vibe. It's a sort of less muscle loss, more fat loss, etc. And so these are still popular. And it's interesting, a lot of the investors I spoke to, they're sort of like, well, we can't really afford not to be in these deals with these assets that are, well known, not that differentiated, but might be differentiated enough to make a lot of money, because our investors in turn, they won't forgive us if we miss out on some of these huge deals. Some of these biotechs that are then acquired, like we saw with Pfizer for Metsera, the deal was 10 billion worth late last year, a bidding war with Novo Nordisk. So the VCs are almost compelled to invest in these familiar areas, to have a shot at a huge reward. So that modality or class, shall I say, rather than modality, is definitely still in fashion. But you're right. We're also seeing ADCs and sort of conjugate modalities more generally remain very popular indeed. We saw Gilead buy Tubulis. That was an ADC company with a sort of mid-clinical stage asset, not that far down the line, but importantly, conjugation technology there. So those modalities, conjugate modalities, again, China's very good at those kinds of things. The ADCs, the bispecific ADCs, the multi-payload ADCs, any permutation you like, it's in there and still popular. And then, yes, I think you mentioned CAR-T. I mean, that's interesting, CAR-T cell therapy, because it's obviously struggled commercially in the corner of oncology, in the liquid cancers where the products exist and are on the market. They're extraordinary and transformative for many patients, but they're incredibly cumbersome, expensive, and quite difficult to make a success of commercially, certainly compared with a Manjaro or whatever. So now scientists are looking at whether they might be used in autoimmune disease, which are obviously a much bigger market. So those are interesting as well. And next generation CAR T, of course, includes in vivo approaches where you avoid the sort of cumbersome cell extraction and then manipulating cells outside the body. You basically inject the instructions for the genetic manipulation into patients, so it's a much more convenient, quicker process. So that's exciting.
And there were some amazing results come out of ASCO, I think, for an in vivo CAR T as well. So there's promise in that area, obviously scientifically, but also commercially for those developing these next generation products.
Absolutely. I mean, if you think of the size of autoimmune disease condition like rheumatoid arthritis or lupus, compared with a sort of late stage refractory multiple myeloma, I mean, obviously the seriousness of disease is a different level, but it's just a hugely different size market, and there are different dynamics as well playing out. So, other companies looking at T-cell engagers to do the same job as CAR T-cell, just because they might be a bit more easy to control and administer. But yeah, it's a very interesting area, and we're seeing lots of deals in that domain.
Okay, will be interesting to see how that pans out in the next 12 to 24 months. This is an annual review, but what multi-year shifts can you see occurring? And you have mentioned China at least half a dozen times, so I'm guessing that's one of them.
Yes, so that is only going to get more important as a global player. I think I get asked, well, what's happened? How did it do this? And this is part of a strategic plan that's more than a decade old from the Chinese government. And we're in sort of stage 4 of 5, and they're now producing best in class molecules very quickly and efficiently. But, Chinese companies are not going to want to just be sort of CDMOs to the rest of the world forever. They want to go global. I think we're seeing the beginnings of that if you look into the details of some of those earlier multi-asset R&D licensing deals I mentioned, BMS Hungary, for instance. I mean, these companies, the Chinese partners, have ambition to sort of co-promote in the US to build a commercial presence outside of China in these more valuable markets. So that shift will continue and it will change. The other thing to bear in mind that China as an end market is important as well. I mean, today it's a low-cost, generic dominated market, but it's starting to show signs of premium pricing for certain products, and obviously there's a private market, and that'll just continue to get bigger. So for sure, China, and then of course AI is coming along everywhere, and those interested can look at my other feature in Nature Biotech published recently about, the impact AI is having on drug discovery, speeds and the nature of that process, as well as development, of course. And then the third multi-year trend I just mentioned is drug pricing, not a new theme, but I think if you just reflect on what's changed just in the last 3 years in US pricing, it's extraordinary. So I think that is having knock-on effects on company focus, strategy, and pipeline building strategies, and that will continue.
That's great. Thank you very much, Melanie. Finally, this is certainly shaping up to be a good year for biotech so far. We're halfway through. Will we look back on 2026 as a golden year?
Maybe. Did you really think I was going to come down on one side or the other? I've called so many years in my reporting. I've called this the sort of the dawn has arrived, etc. Since the crisis after the pandemic. So I'm very cautious. If tech and AI crash, on the one hand, it brings down the whole market, but on the other hand, it means investors may go back into defensive spots like healthcare and biotech. So this could be the beginning of a golden era, and it could be very positive, depending on how things play. But of course, I'm not alone in avoiding predictions.
No, I think you're very wise. Melanie Senior, thank you very much indeed. Melanie's articles, there will be links at the bottom of this piece, so please go down and read the pieces. Biotech's Coming of Age and Programming Biology. Melanie Senior, thank you very much.